The draw on liquidity is the final piece of the puzzle when you are creating a model which has a high percentile win rate, because PDRA, top-down analysis, and entry confirmation do not and will not work if you do not know where the market will go next. Well, today we will learn that in the form of a draw on liquidity. Welcome back to another video. Today's video will have two parts. First, the theory part, and second will be a chart example. But before diving into the secret movement of the market, please hit that subscribe button, like, comment, and share this video. Let's get to the video, guys. And oh well, before we go into the video, we are not going to go through all of the time frame because of the fractal nature of the market. So if you know the draw on liquidity on the 15-minute time frame, you know you can apply the same basic rule on the daily time frame or on any time frame, because the market is fractal in its nature. Whatever happens on the 1-minute time frame, the same rules apply on the daily time frame or on the monthly time frame. So it's all about taking the rules that you learn on this time frame and applying them on a different time frame to find your draw on liquidity. Right now, let's start with the video. Okay, guys, now we're going to deal with the theory part of this video first. And to do this, I need every trader to understand that there are three things in particular that I use to summarize a draw on liquidity. So in order for me to know where the market is, whether the market is bullish or bearish, I look at three core fundamental rules. Okay? I'm going to discuss these rules in details one by one as I go through this video. So I'm not going to name them all in advance at the beginning. So if you want to know the three rules, then you have to stay here for the whole video. So let's go to this chart. If you realize, and you're in this chart, you realize that you want to know where the draw on liquidity. If you look at the structure here, if it's confusing for you, I'll make a video about advanced market structure somewhere in the future. So this is what is known as an advanced market structure. The simple market structure or the basic market structure is when the market is making a series of higher highs and higher lows, or a series of lower lows and lower highs. That's the basic market structure. But when the market is moving chaotic like this, in order for you to trade it, you must know how the advanced market structure moves. So if you have this low and you have this high. The minute we make this high, we realize that this becomes our external liquidity, external buy side liquidity. What does that mean? This means that on this time frame, this is going to be our draw on liquidity. But the market does not move randomly. So for the market to come and attack this liquidity, it must move from one thing. The market moves from liquidity to liquidity in the form of, it moves from internal liquidity to external liquidity, or from external liquidity to internal liquidity. And when it's moving from liquidity to liquidity, we can summarize it as if the market is moving from either a fair value or liquidity. So the market moves from fair value to liquidity, or from liquidity to fair value. So when you see this, you realize that the market made this low. When the market retraces down, you realize that you come to this leg and you search for your fair value. Fair value is a fair value gap. Anything that has to do with a fair value gap in the form of a fair value gap, a volume imbalance, or a gap, that's what you do. But you must look for your fair value price in a discounted market. So you first tend to take out your FIB to look out for your discount and premium, and as soon as you find your discount and premium, you look for your fair value price there. That's where the market is going. So that becomes your draw on liquidity on that particular leg. So you realize that the market from this high will move to come, because it cannot attack this low, because the market does not move from this high to this high to the next high to the next high. It has to move from this external liquidity to fair value, which is under or below internal liquidity. So there will be some type of a low here, but I'll get through that sometimes in the future. So the market moves from this high to this fair value. So when the market is moved from this fair value, then that's when we go to step number 2. Okay, you understand that step number 1 is you must know where price is coming from. So price then is coming from this high. So when you know this price is coming from, this means because price will move from liquidity to fair value, or from fair value to liquidity, you must investigate whether your price is coming from. So now we know that the market made this low, and as soon as the market start making a series of lower highs here and lower lows, we know that price will end up at a fair value, which is in a discounted market. So this is now we know where the market is moving from. Now we understand. Now we go to step number 2. Step number 2 is you must understand where price is currently at, right? So if the market is somewhere in between here, let's say price is stuck somewhere in between here, you realize that you have this high and you have this fair value, and price is here. We already made a high, and the market cannot move randomly and come and take out this high. The market has to take out liquidity or go to fair value. So when you are here, meaning that if price is still varying from a fair value to liquidity, or from liquidity to fair value, we realize that the market comes from here, from this high. This high, maybe supposedly on a higher time frame, it took out some high. Maybe let's say there's a higher time frame PDRA here, or if no, a high is a high which was taken here. So we already taken a high here, then we made a high. Then the market took a high. After taking out liquidity, the market will seek fair value. That's where you must know where your price is. If your price is here, which is still in a premium market, we realize that the market has to come in a discounted market. And where is our discounted market? It will be here. So in a discounted market, you look for your fair value price. That's how you understand where price is at currently. The third rule of this concept is you must know where price is going next, right? So what do I mean by that? If you already know that the market moved from liquidity to liquidity, or from liquidity to fair value, or from fair value to liquidity, you must know that as soon as the market take out this high and it creates a high, this becomes our drawn liquidity. And in order for the market to come and take out this liquidity, the market must retrace into a fair value, which is in a discounted market. So this is a price of knowing that the market is now in a fair value, in a fair value. So where will price go? If the market comes to a fair value here, there's no reason for the market to keep on going down. So if the market is here, then we know that this high is our next target, because price will move from this fair value to this liquidity. So we understand that the market will move from this fair value to liquidity. After making this high, what do we see here? This high becomes our liquidity. So every high is a liquidity. So this high becomes our liquidity, and this low becomes our liquidity, which is our previous fair value. So the market is here, and the market makes this low, and the market makes this high. It's a random high. That's why we do not trade like this. We have to wait for a market structure shift. So when it makes this high, we have another secondary liquidity here. Then we have a break of structure to the downside. When we have a break of structure to the downside, we know that this liquidity up here is protected for now. So which liquidity is going to be taken next? The liquidity that is going to be taken next is this one and this one. But the market cannot go from this liquidity and attack this liquidity. So the market has to come and create a low, which is an inducement again. This inducement here, we realize that when we have this inducement, the market has to come and take this internal liquidity and this external liquidity. But it will move from what again? Rule number 3. Where is price currently at? Price is currently at a fair value here. So now we know that this price at the fair value here, that's where price is at currently. So if price is at the fair value, and we have this high here, which are protected, because now we know that the price will move from this fair value to the sell side liquidity. So now if you want to take entries, you go to a smaller time frame and refine your market here, and that's when you look for your pattern recognition. Then you say, okay, now I have a breakup block, I have a fair value gap, or I have what. That's where you sell. But now we are not talking about pattern recognition, we are talking about draw on liquidity. So the market is at a fair value here. What is a draw on liquidity? A draw on liquidity is this inducement and this low and this low. So we expect the market to come below these lows here. So when the market comes below this low again, we have the market coming below this low. What did the market do by coming below this low? It took out the liquidity that was here. So there's no need for the market to go down again. So you wait for what? You wait for a market structure shift. Instead of a market structure shift, we have this low. We have the market making a high. When the market makes this low, this low becomes liquidity. So the market comes and clear out this liquidity before attacking the buy side liquidity. So when it clears out this liquidity, this becomes your target. This becomes your draw on liquidity. Don't make it complicated. And how do? You wait for the market to create a low, which is now future liquidity. Then we have to wait for the market to create a high, which is another immediate liquidity. And this high, when the market makes a higher low here, it's telling you that it's unwilling to go down and it will go back up. So you have to wait for the market structure shift by going above this liquidity here. And when the market goes above from this liquidity, it moves from fair value here and above this liquidity and created this high. So now we have a market structure shift that you know that this becomes our drawn liquidity and whatever. Let's say we have a fair value gap here or a fair value price. Let me not say a fair value gap because that will limit you to a fair value gap only. Fair value, I mean fair value gap and volume imbalance and a gap. So when this market closes here, we look for fair value price here in a discounted price. So because now we know that the market will move from this liquidity and will seek fair value before coming up and attacking this buy side liquidity, and we end up here. And when you end up here, you realize that now we're at a fair value gap. If you are at a fair value gap, these highs are still protected, meaning that the liquidity that is supposed to be taken is the sell side liquidity again. So the market, you wait for the market to create a low, create a higher, a low which is a high which is lower, then break structure to the downside here. Then break structure to the downside here. You wait for the market to break structure to the downside, and you have what is known as a break of structure. When the market first go below a low, it's known as a break of structure. Then we have the market making this high here. Where does this high goes from? It goes from down from this liquidity, and it seeks fair value again. So the market move from liquidity, taking out liquidity, to fair value. Then from fair value again, we know that this is your next liquidity. This is your next liquidity, and this is your next liquidity, and this is your final liquidity, because there are no lows which are relatively close. So before the market will go for long-term lows, it has to take out this buy side liquidity first. Then we realize that from fair value, now we are going to target this liquidity. So you can sell from here because we have this break of structure here, signaling to us that the market is going down. Whenever you see a break of structure, now we know that the market is going to seek sell side liquidity. But which sell side liquidity? Because the market can simply come here and find that it's seeking fair value from here in order for it to go up and above this high. But if the market goes into a fair value here, if the market goes into a fair value gap, it's a clear indication or a strong indication that the market will not seek this liquidity. If it wanted to take out this liquidity, it was going to go above this high first. When it goes above this high, it takes out this liquidity, and it takes out this liquidity before going down. So now, because we understand that the market went into a fair value and created a market structure shift to the downside, we know that this becomes our draw on liquidity. This and this and this. We wait for the market to come and take out this liquidity. And when the market takes out this liquidity, maybe you are now in a London session or the Asian session, and you're trading the New York session. Let's say you're trading the S&P E-mini futures or the Nasdaq, which they move sluggish during London and Asian. So in Asian time, you find that the market is making a series of lows, which is your your strong sell side liquidity, and you have the market making a series of equal highs. So what do? You wait for the market to show you its head. Its hint is that the market took out this liquidity, and from this liquidity, the market is going to seek fair value, then attack this liquidity. So you wait for the market to say, okay, I'm willing to go up. The first liquidity that the market takes, that's usually where the direction where the market will likely go, right? So the market takes out this liquidity and takes out this liquidity. In a rare occasion where the market takes out liquidity and takes out liquidity, whether it doesn't go from liquidity to fair value. Why does it not go from liquidity to fair value? Because this is a strong liquidity, and the market wants to go up. So it cannot move from this liquidity to fair value gap and leave out this liquidity before going up, right? So the market has to take this high, take the buy side liquidity, take the sell side liquidity, so buyers and sellers are liquidated. So when did this happen? Because we know that the market is now going to go up here. Why is it going up here? Why is this high? Our drawn liquidity. These highs are our drawn liquidity because we have no highs that can be taken below. This low has been taken, and the market, is you can see, is refusing to go up by making a series of equal lows. So when these equal lows are taken, we do not look far back or a month back or 2 weeks back to look for our low that we think the market can go. Well, there was this immediate liquidity that can be taken here. So we expect the market to come create a high. Then when the market creates a high, this becomes a protected low, right? Then after this high, the market will seek fair value in a discounted price. So you can take your entries at the fair value, you target this high, this becomes your first target. Sorry, this becomes your first target, this becomes your second target, this becomes your third target, or you can target overall. This becomes your first target, and when you reach here, you take out your partials, and now you target your full position as this. Okay, guys, that was the theory part of this model. Now let's go to the chat and look at the example of what I'm talking about. If you're still with me here, please subscribe to my channel, like, comment. It takes a lot of effort to make this video, so I'll appreciate it if you guys just thank me by liking this video and subscribing to this video. Watch it till the end, learn all you want, go to the chart and decide what to do. I'm not going to give you financial advice to say put money into the market and trade, because I'm not regulated to do that. So do this on a demo first, test it, back test it as thoroughly as you can. Everything that I put here, you must back test it before you take it out. You take it and do whatever you think is right for you with your money. I'm not gonna say what you should do and what you should not do. But without wasting too much time, let's go to the chart and look at a few examples. Okay, guys, because the theory part is a bit longer than I wanted it to be, but I wanted to include as many information as I want. So this part is not going to be it's not going to be too long. So I'm just going to go through this because you already know the theory part of this video. So let's say you have this leg and you have this leg, right? You have this low here and you have this high. So before this high was created, which was your high? Your high was here, right? This was your high. So you expected the market to come, the market made a low, then the market made a high. So in what does it requires for the market to take out this high? The market has to go into a fair value. So the market has to go into a fair value before taking out this high. So where is our fair value? Our fair value becomes something here. Okay guys, so before when you're discussing this, when you're trading this model, I want you to take out a piece of paper or put it on your wall or take out or on your second screen or wherever you can see. Then you must know that you must know the three rules, which you must know where price is where price is coming from. You must understand where price is currently is, and you must understand where price is going. So first understand, I need to know where price is delivering from. So here we realize that price is delivering from this low to this high. So in order for the market to come and take out this high, the market has to go into a fair value. So the market goes into a fair value and come and take out this high, right? So when the market takes out this high, now we know that this becomes your draw on liquidity. Why is it the draw on liquidity? Because the buy sell liquidity has been taken by the market going into this fair value here, right? So we know that the market after this high, the market is going to attack this internal liquidity, which is gonna attack this low, which is our internal liquidity, and ultimately this external liquidity. But before it goes here, it must move from liquidity to what? To fair value, and from fair value to liquidity. So where is our fair value? So the market will come and take out this internal liquidity here. The market takes out this internal liquidity here, and when it's taking this internal liquidity with this candle, it creates a fair value. So now we know price is coming from here and it's coming for this liquidity, and it takes out this liquidity, and for it to come down to this liquidity, it has to go into a fair value first. So the market moves from this internal liquidity into the fair value. When it created this when it was going into this fair value, it created this liquidity here. This low becomes a liquidity, raw liquidity, intertime frame liquidity, and your internal liquidity. So this becomes your drawn liquidity, and this becomes your long-term drawn liquidity. So the market taps into a fair value, and where does it go next? It has to attack this liquidity. It goes below this liquidity. And what happens next? The market goes, and if you can see here clearly, the market shows you that it's not willing to go down just yet. Why does it not willing to go down? Because it want to attack internal liquidity, which is this high. So the market come and take out this liquidity with this candle and closes above this low again. So when you see this happen, it's trying to show you that I'm not done taking liquidity from the upside. So before going down and taking liquidity far back, this liquidity has to be taken. This liquidity has to be taken, right? So now the market makes a high. From this liquidity, the market makes a high. It doesn't take any liquidity. There's no liquidity that was taken here. Market simply makes a high, and the market makes a low. So there's no liquidity taken, and there's no liquidity taken because this liquidity is intact. Now this shows us that the market is still going to go down, but it cannot go down to this drawn liquidity before taking out this internal buy side liquidity. So the market comes and make this high, and comes and make this high here, then make this low, then come and take out this buy side liquidity here. But when the market is taking out this buy side liquidity, it created this low. This is now your sell side liquidity. So from taking out this buy side liquidity, the market goes to internal liquidity and clear out the internal liquidity. So where to now? We do not have fair value in here. Okay, we do have a fair value in here, so that's what I see. We have a fair value here, which was tapped into before the market took out this low. The market created a high, created this low, and tapped into a fair value before taking out this internal liquidity. So now where is our next liquidity? This is our next liquidity. Why is this? Why am I saying this is our next liquidity? Because if you can see, the market closed above this candle. When the market closes above this high here, this candle closes above this high here, it shows us that the market is still going to go down. You have to wait for the market to close below this low. So this becomes your low, sorry, your high. And when it comes here, that's when you can see the market takes out liquidity and close below this low. And now this is confirmation that the market is going to seek sell side liquidity. Which sell side liquidity? Our long-term sell side liquidity and our short-term sell side liquidity. So our short-term sell side liquidity gets taken with this candle, then the market created this low, the market created high. It does not go into this fair value, so it's favoring this fair value for future take, and it created this high just below, just above this high, this fair value here. So the market goes down, and take out this liquidity here. We have the market taking out this liquidity and snapping up and going up. So when it go up, it created something like equal highs here. These are our equal highs. But the market goes down and attack this sell side liquidity. And when it attacks this sell side liquidity, watch what it does. What does it do? The candle closes below this low. So when the candle closes below this low, it tells you that the market is not done going down. So the market goes and create this low, which is our next draw on liquidity. Why is it our next draw on liquidity? Because this is where we expect the market to go, because we are bearish. But the market, for the market to go to bearish, it must go to fair value. And that's why I'm saying fair value and not fair value gap. Because if you realize that here, fair value is no longer a fair value gap, but now fair value is a volume imbalance. So now the market moves from this low after taking this liquidity, sell side liquidity, and it taps into this fair value in the form of a volume imbalance before taking out this liquidity. So the market goes, and what happens here is you have the market going to this candle. So if you realize this candle, you say, okay, but there's no fair value here. Fair value here. So if you want to see the fair value gap here, that's when you use multiple time frame. So if you go to the small time, let's start with the 4-hour time frame and see what the 4-hour time frame will have for us. And what do you see? Well, before we even go through the lower time frame, we found what we're looking for. On the daily time frame, there is no fair value, but on the 4-hour time frame, we find that we have multiple fair value. We have this fair value here, and we have this fair value here, fair value price, right? So that's why on the daily time frame, the market seems like it's going to an order block, but realistically, on the 4-hour time frame, the market is going to a fair value. So you can realize that the market tapped into a fair value on the 4-hour time frame instead of the daily time frame, right? Now that you understand the fractal nature of that market, let's go back to the one daily time frame and see how price delivered from there. All right, now we're back on the daily time frame. So you realize that this is the 4-hour fair value and this is the upper 4-hour time frame fair value. So the market went into a 4-hour time frame fair value. Then the market now is ready to attack this sell side liquidity. So that's how I look at the market, guys. So I think I'm going to stop the video here. But if you go through this example with me, or you continue from here, you realize that you have this low, you have this high, you have this low, you have the break of structure to the upside taking structure, and the market tapping into a fair value. And when tapping into a fair value, the market comes and make a low here. And when the market makes a low, the market makes another high. The market takes out this low here. And after taking out the liquidity from the downside, we have this buy side liquidity which has to be taken all the way to up here. But with the market going up here, why is it going up? It's going above this liquidity here and tapping into this fair value here, and before going down. So it goes down, created a low, tap into a fair value, take out the low, and this low, create a fair value, go to the fair value, take out this liquidity, go down, take out this liquidity, and so on and so on. So I can go on about this. I can talk. This is something that has made tremendous changes to my trading. Okay, guys, so I'm stopping here so the video does not become unnecessary long. And if you have enjoyed this video, don't worry about it being too long. It's worth it. It's worth it. So watch it all. Now subscribe, comment, share this video. Tell me what you do. Tell me what you think. We'll meet again next time. Peace out.